Most traders never find a clean setup, not because they don't know enough, but because they know too much. Fibonacci, RSI, MACD, 3 moving averages, a handful of indicators, and half a dozen smart money concepts, all stacked on the same chart until the chart stops speaking to them entirely. In this video, we're doing the opposite. We're stripping it back to 5 concepts that actually matter and stacking them into one clear day trading plan you can run every single session. If that sounds like something you need, hit the like button and stay with me to the end, because the real chart example at the end is where it all clicks. First, the ground rules. This is a day trading strategy. We open and close positions within the same trading day, and we never hold overnight. No swap fees, no waking up to a gap against us, no weekend risk. To run it properly, you need the core smart money concepts. These are the foundation. Get them right, and the strategy works. Get them wrong, and no amount of screen time will save you. So let's recap them quickly and clearly. We start with supply and demand. A supply or demand zone is simply an area where a large number of traders entered the market at once, and price moved away from it aggressively. That aggression is the clue. It tells us serious money was committed there, and that unfilled interest may still be sitting at that level. So we mark the origin of a strong move as our zone. When price returns, we expect a reaction because something happened there before. But here's what separates profitable traders from the rest. Not every zone deserves your money. To grade a zone, we use 3 filters: inefficiency, break of structure, and push distance. Inefficiency first. When price leaves an area too quickly, it leaves an imbalance between buyers and sellers, a fair value gap between candles. That gap is proof the move was violent and one-sided. It also gives price a reason to come back later, which is exactly what makes the zone that produced it worth watching. Second, break of structure. In a bullish scenario, price must break the most recent structural high. That break is confirmation that buyers are still in control and the trend has permission to continue. Third, push distance. How far price traveled away from the zone before returning. The further it ran, the more decisive the rejection, and the more respect the zone earns when price comes back. Put all 3 together and you stop marking every dip on your chart. You mark the few that matter. Look at this example. The latest impulsive move ticks every box. It left a fair value gap, it broke the previous structure, and it pushed price significantly further than the moves before it. When price retraces into that demand zone, the odds genuinely favour a reaction and a continuation higher. But what if price breaks straight through it and closes below? That question takes us to the next concept: change of character. If price breaks and closes below a high-quality demand zone, buyers have failed to defend the level and sellers have taken control. Market structure has shifted, momentum has flipped, and the uptrend is likely finished. That shift is what we call a change of character. Simple enough, but there are 2 situations where a change of character lies to you, and both of them are traps that catch traders every single day. The first is a liquidity sweep. Take this swing low. Price breaks below it, and on the surface that looks like a textbook change of character. But look left. That level lines up with a significant liquidity pool, a place where a crowd of traders went long and tucked their stop losses just underneath. Those stops are resting orders, they're fuel, and smart money knows exactly where they sit. So price is driven below the low, the stops are triggered, the liquidity is collected, and then price turns straight back up in the original direction. So the rule is this: when a major swing low sits inside a liquidity area, a break below it is far more likely to be a sweep than a genuine reversal. And if price sweeps that liquidity and then closes back inside the range, that's not a warning, it's an opportunity. The trend is still bullish, the sell side liquidity is gone, and the next target becomes the buy side liquidity above. Our job is to enter after the stops have been taken, not before. The second trap is an unmitigated fair value gap. Marking fair value gaps should be one of the first things you do on any chart. because price treats them like magnets. Very often, the market will reach back to fill an imbalance before it continues on its way. On intraday charts, the 4 hour, the 1 hour and below, this happens constantly. So back to our example, look to the left again, and you'll find an unfilled fair value gap sitting just below that swing low. Price dips into it, fills the imbalance, and carries on in the original direction. That was never a reversal. That was the market rebalancing itself. The takeaway is the same in both cases. Before you trust a change of character, look left. Check for liquidity resting below the level, and check for gaps that still need filling. That one habit will save you from most false signals. Third concept, market direction. Who is actually in control? This is always the first question on any chart because trading against the dominant side is the fastest way to lose money slowly. The system runs on mitigations. When price mitigates a demand zone, demand takes control. When price mitigates a supply zone, supply takes control. That's the whole mechanic. Picture an uptrend. Higher highs, higher lows. Every time price breaks structure upward and leaves an inefficiency behind, a fresh demand zone is created. Those zones sit there unmitigated, waiting. Each one is a potential place to join the trend. Now price breaks below a valid demand zone. Two things happen at once. Supply has taken control, and a new supply zone has just been born. Price works lower, printing new supply zones as it goes, until it reaches the next unmitigated demand zone. And there a fight breaks out. Supply above, demand below. Often price simply ranges between them. Whichever side breaks first tells you who won, and that is where we take our trade. Fourth, order blocks. An order block is a refined supply or demand zone, the precise candle where the serious money was committed, rather than a wide approximate area. We take the first candle that creates a fair value gap and mark that as our order block, because that candle is where the decision behind the move was made. When price returns to it, we expect a reaction, and how strong that reaction is depends on whether unfilled orders are still sitting inside. One honest caveat: order blocks are not magic, they fail. They are probabilities, not guarantees, and they only earn their keep when stacked with the other concepts in this video. Anyone selling you an order block as a standalone system is selling you something. Fifth and finally, top-down analysis. This is the glue that holds the other four together. We start high, the daily chart, and answer two questions only. What is the overall direction, and where are the key levels? Nothing else. We are not hunting entries here. Then we drop down. 4 hour, then 1 hour. Carrying that bias with us, and we look for a precise entry using the concepts we've just covered. The higher time frame tells you where to look and which way to face. The lower time frame tells you when to press the button. Keep it that simple, and resist the urge to add anything else. Now let's put all five together on a real chart. Dollar-yen daily. On the daily, we mark two things: the most recent high and the most recent low near current price. These have already acted as turning points, so we expect a reaction when price returns to them. We also notice the latest bearish impulsive move left a bearish fair value gap. We mark the candle responsible for that imbalance as a bearish order block. That becomes our area of interest for selling. Price is trading near it right now, but the daily is not our entry chart. Our read here is simple. Sentiment is bearish and there is room to run before the next demand zone. Down to the 4 hour. Clean downtrend. Lower highs, lower lows, one after another. Same conclusion, more detail. We want to sell in line with the trend, but we still don't have a precise entry. So we drop to the 1 hour, and here it gets interesting. Short term, price is bullish. The latest impulsive leg left an imbalance and a demand zone, and we mark the candle that caused it as our order block, refining it with the wick of the next candle. Now we have a genuine battle. If price holds this 1 hour demand, it may push higher, possibly all the way into the daily order block. If it breaks and closes below, supply has won, and the short-term rally is finished. Watch what happens. Price breaks below the 1 hour order block and closes there. Supply has taken control, and now the lower time frame agrees with the higher time frame. That alignment is the whole point of top-down analysis. Our entry is mechanical from here. We wait for price to form a fresh, bearish order block, place a sell limit at that block, and set the stop above it with enough room to breathe. Take partial profit at 1 to 2 risk to reward, and let the rest run toward the key levels we marked at the very start. One last thing, and it might be the most important thing in this video. Patience is not a personality trait, it is a skill, and it is trainable. Most traders, especially early on, overtrade because being flat feels like doing nothing. But sitting on your hands while your setup builds is doing something. It is the job. Quality over quantity. Every time. If this brought the pieces together for you, smash that like button and subscribe if you're new here. See you in the next one.